High inflation along with rising interest rates are causing real financial hardship for many Canadians, especially people on low incomes. The head of the Bank of Canada plays a key role in managing both those things. And Tiff Macklem joins me now. He's in Halifax today. Mr. Macklem, the bank has faced criticism for increasing borrowing costs at a time when we know so many Canadians are already struggling to afford groceries and gas and other essentials. Today, you said more interest rate rises are coming. Can you say anything to reassure Canadians?
Well, Dawna, you started by saying inflation is high. Inflation is too high, and Canadians can be reassured that we are acting with determination to bring inflation down. I get it that it is a bit counterintuitive. We're raising interest rates. That's raising the cost of borrowing for Canadians. But actually, that is what the economy needs, because by making borrowing more expensive, people are going to borrow less, spend less, and save more. And that's going to take some of the steam out of inflation and bring inflation down.
You know, last year you predicted rising inflation was transitory, that it would settle down again. This year, inflation reached a 40-year high earlier this year. What went wrong with the central bank's forecasts?
Well, thanks for reminding me, Dawna. What went wrong? At the beginning, this inflation was very much caused by global supply problems. And usually, those supply problems have a reasonably temporary effect on inflation. So we tend to look through them. Unfortunately, that turned out to be overly optimistic this time. As you'll remember well, in February, Russia invaded Ukraine. We saw a further increase in these global inflationary pressures, and inflation moved up another leg. The other thing that's happened, though, more recently is that increasingly inflation in Canada reflects what's happening in Canada. The economy is overheated, and we need to cool the economy, and that'll relieve some of those price pressures.
Well, I know you talk about restoring price stability and that's key, but can you explain in simple terms why continuing to raise interest rates here in Canada will contribute to that when other factors outside the country are stoking inflation?
You're right. You know, the rapid run-up that we saw in inflation over the last year or so was largely driven by these global factors: higher oil prices, higher wheat prices, higher prices for many globally traded goods, bicycles, appliances, things that people really wanted during the pandemic. Those global price pressures, they're still elevated, but they're starting to ease. But what we're seeing is that as the economy's reopened, there's now very strong demand for many services, recreation, tourism, restaurants, and businesses are having a hard time keeping up, and that's creating domestic inflationary pressures. And by raising interest rates, we can improve that balance between demand and supply here in Canada, and that'll cool those domestic inflationary pressures. That's what we're focused on.
You've raised the Bank of Canada rate 5 times now since March. How high could it go?
Well, when we raised by 75 basis points in September, and we indicated at that time we expected interest rates would need to go higher still. And today I'm in Halifax, and I used the opportunity in my public remarks to reiterate that we did think higher interest rates were warranted. So we've been clear on the direction. How high they go for how long is going to depend on the evolution of the economy and, importantly, the evolution of inflation. And what I can say is, what are some of the key things we're watching? We're watching how higher interest rates affects demand in the economy. How rapidly is it cooling? We're looking at these global supply and domestic supply issues. How quickly or how slowly are those getting resolved? And the other thing we're watching closely is inflation expectations. It's really important those stay anchored on our 2% target. So as those inflationary pressures cool, inflation comes all the way back to our 2% target. So those are the key things we're watching. What I can say is that it is our job to bring inflation back to target, and we are determined to do it.
You know, back in July, you told business leaders not to raise wages for their workers, and you've been heavily criticized for that. Why did you give that advice, especially given the increasing income inequality in this country? It's not the rich who are suffering, it's the average worker.
The reason, first of all, what I said is that same thing I'm saying today is that we're taking determined action to bring inflation down. And businesses, workers, households should expect, they should plan on inflation coming down. So when they're setting multi-year contracts, they should plan on inflation coming down. Why that's important is that there is a risk that we could get into something that's called a wage price spiral, where higher inflation pushes up wages, that pushes up inflation again, and then inflation starts to become reinforcing. If that happens, those inflation expectations I talked about can become unmoored. And then, unfortunately, we'll have to raise interest rates a lot more and slow the economy a lot more to get inflation back to target. We're really trying to avoid that. What I will say is that so far we do not see a lot of evidence of a wage price spiral. I think Canadians are getting the message. They are showing confidence that they do believe inflation is going to come back down.
Yeah, well, I guess that's the key question, right? We're bringing the inflation rate down to 2%. As our viewers try to make financial plans for the future, how much confidence can they have in that?
Well, look, there's a few reasons why I think Canadians can have confidence that inflation will come down. The first is we've been targeting inflation in Canada now for 30 years. And we have a very strong track record of bringing inflation back to target. I will admit, this is the biggest test we've had to our inflation targeting framework. Inflation has never been this high in 30 years. But we've had fluctuations in inflation before, and we've used our interest rates before to bring it back to 2. So I think we've got a record of success, which should give Canadians some confidence that we can do this again. The second thing is we've taken determined action. We've raised interest rates by 3 percentage points, 300 basis points since March. It is starting to cool some parts of the economy. And over time, those interest rate increases will feed through to the economy more broadly, and Canadians can be confident that will bring inflation down.
All right. Mr. Macklem, Deloitte released a report last week suggesting Canada is headed for a recession by year's end. Is that your view? And if so, how do you mitigate it?
Our mandate is clear. Our primary mandate is price stability, which means bringing inflation back to the 2% target. We are a long way from that target. We do want to do that in the best way possible. As I've mentioned, we're going to have to cool spending. We need a period of below trend growth so that supply can catch up and we can relieve these inflationary pressures. Below trend growth doesn't mean you need a recession. It could be just very low growth. That's the soft landing. We do think there is a path to soft landing, but I won't sugarcoat it. It's a narrow path. And there are risks around that path. And some of the things that'll really affect that path are how sticky is inflation in Canada? How quickly do those global and domestic supply issues get resolved? How well anchored do inflation expectations remain? The quicker those things get resolved, the better inflation expectations remain anchored, the better is the chance to have a soft landing. The last thing I'll say is that by front-loading our interest rate response, that's the best chance of getting a soft landing. Because by front-loading, what we're doing is we're trying to avoid the need for even bigger interest rates down the road and a bigger slowing down the road.
A final question. The leader of the opposition, as you know, has said if he becomes prime minister, he would fire you. He's accused you of shirking your responsibility and allowing the Bank of Canada to be what he calls an ATM for Prime Minister Trudeau's spending during the pandemic. I know you've said you don't want to comment on that, but help me understand why you don't want to defend yourself. And do you think that the leader of the opposition maybe doesn't understand what instability firing the Bank of Canada governor would cause?
I'm focused 100% on the job that we need to do. Coming out of this pandemic, the pandemic has caused havoc. It's turned our lives upside down, and one of the consequences is high inflation. It's not just here. It's not just here in Canada. It's in almost every other economy around the world. And we have an independent central bank for a reason in this country. and that is to control inflation, to deliver price stability. And I can tell you, I go to work every day. That's my focus. Inflation is hurting Canadians. The best way to protect Canadians from high inflation is to eliminate it.
All right, Tiff Macklem, Governor of the Bank of Canada, thank you for taking time with us.
A pleasure, Dawna. Thank you.